Good morning, everybody. Ed Yardeni here. It's January 2nd, and as you can tell from the background, it's a very bright day here in Long Island, a little on the chilly side, but no snow. We did not have a white Christmas. As a matter of fact, it was pretty warm on that day, but we had a good time, and we've enjoyed the holiday season. My wife got this. Actually, I think my mother-in-law got me this. I forgot who got what, but my family got me this thing. I'm actually thinking of doing a clothing line in 2024. So if any of you want to provide capital for a new clothing company that promotes the Yardeni Research logo, let me know, and then we'll take it public and we'll get wildly rich and so on and so forth. Meanwhile, I'm very happy doing what I'm doing and very happy that all of you folks are tuned in, and hope you had a great new year, great holiday season. And now it's time to get back to work. Never a dull moment in our business. Let's face it, the past few years have been crazy years. 2020, we had the first wave of the COVID. 2021, we had the second and third waves of COVID. Then 2022, Russia invaded Ukraine. And in 2022, inflation reared its ugly head and created a real problem in 22 and early 23. Then, of course, we've in 23 we've had more agitation in the world with the war in the Middle East. So it's been basically 4 years of living dangerously, and despite all that, from the end of 2019 to the end of last year, the market's up almost 50%. So that's all in all pretty impressive performance, given all the dangers that lurked over the past several years. Question about 2024, is it going to be another year of living dangerously? I think the answer is, of course it is. I mean, it's already starting out quite dangerously. We still have the war in Ukraine. As a matter of fact, it seems to be revving up in terms of more strikes by both sides to do as much damage as they can to one another. There's some talk that Putin is ready to have a ceasefire and maybe talk, but who the heck knows when it comes to that situation. But it certainly is a precarious situation. Then, of course, the other dangerous situation is what's going on in the Middle East now that Iran is showing up, at least with one ship and its naval forces in the Red Sea. The Houthis keep doing what they're doing, launching missiles, and the U.S. and allies continue to fend them off. But it's certainly a volatile situation. So far, it hasn't led to a major problem with regards to the global economy and oil prices. But obviously it could, and that's something to watch for. I think now that everybody seems to be relaxed that inflation is moderating and that the 1970 risks is behind us, I think we have to be aware that things could still go wrong on the geopolitical front. And if we do get another spike in oil prices, that would be sort of deja vu all over again with the 1970s, though I think any spike like that would probably cause a recession pretty quickly. So I'm not sure that inflation would have much of a chance to move higher. But it could spark a recession now that everybody's more relaxed about that issue. The Godot recession, as we called it, it didn't show up in 2022. It didn't show up in 2023. I don't think it's going to show up in 2024, but that's what we have to be putting our attention on, is that where the risks lie in terms of that possibly happening. So I remain optimistic about 2024. I think we'll end up the year at 5,400, but I'm kind of trying to figure out how it's all going to play out, sort of first half, second half. You might recall at the beginning of last year, Wall Street's economists and strategists, many of them, not all of them, many of them, or maybe the ones that were getting the most press in terms of um, the message being sent, there was a pessimistic message. The idea was that we could have a recession in the first half of next year, and the market, so the market would be pretty crummy in the first half of 2023, and then it would be better in the second half of 2023 as the market started to anticipate a recovery in 2024. Well, that didn't play out the way that was widely expected. Instead, we had a really good first half of the year and then a crummy second half for a little while from July 31st to October 27th. And then we had this melt-up rally that brought the S&P 500 almost back to its all-time record high on January 3rd, 2022. A lot of numbers to remember here. And when time flies, you kind of forget which year you're in. But we're clearly in 2024, and looking ahead here, I won't be surprised if there's too much optimism right now that needs to be sort of beat down. So what could possibly increase the dangerous concerns, the concerns about danger among investors? Well, again, the geopolitics certainly is something that could be a concern. In addition to the kind of a slow train wreck movement in this regional war in the Middle East, might accelerate, might continue just to do it at a slow pace, and before you know it, we've got a shooting war between Israel and the U.S. and Iran. I mean, it could get obviously ugly, but I think it'll remain relatively contained. But what has come to the forefront is Chairman Mao, Xi, I'm told is the right pronunciation. I kept mispronouncing his name, so I apologize to him for that. But President Xi of China just is raising the rhetoric and the frequency of the rhetoric about how Taiwan belongs to China. End of story. So my thinking is that China's economy is awfully weak, and China right now can't afford to do something as stupid as invade Taiwan, because that would lead to all sorts of consequences that would be harmful to the global economy, but particularly to China. But then again, sometimes dictators, as they become more authoritarian and have get less advisors to kind of rein in their excesses, sometimes they make mistakes or do things that are just make things a lot worse for themselves and for everybody else. So it's possible that Taiwan would be invaded simply because people aren't feeling very contented in China. There's a high youth unemployment. The economy is not doing well. The property market is basically crashing, and they've got a huge negative wealth effect. So that the Taiwan issue is still going to be very much one on the tables. And I don't know the extent to which foreign leaders are thinking about our coming elections. They must be, and they might be thinking that maybe Biden won't get reelected, and if he doesn't get reelected, then will it be Trump, and will Trump be a lot tougher on these authoritarian regimes, or will he be more America first and let the rest of the world continue to kind of go on its own, or will they perceive that Biden's a relatively weak president, that he doesn't want to start any wars here right before the elections, and that for China this might be an opportunity to invade Taiwan. So it's a concern. It's not something that I can forecast, but it's something that we shouldn't just dismiss. And so, in my bailiwick and the areas that I should know something about, again, I think the consumer is still going strong. I don't expect to see inflation making a comeback. The only problem I have with that scenario is it's kind of the consensus now. I'm not fighting anybody on this issue anymore. There are still a few diehard hardlanders, but they're just waiting for any little piece of evidence they can get that the economy is falling to recession. I think they might get one. I think it's tomorrow, Wednesday. I think tomorrow we might see that the ISM MPMI, the Manufacturing Purchasing Managers Index, will once again be below 50, might actually dip a bit. That's what we can glean from the 5 regional Fed districts. So that may give them something to get excited about. But the labor market still looks strong. The consumer confidence survey that came out for December at the end of last year, that showed that jobs plentiful remains at a high level, and that's highly correlated with the JOLTS reading for job openings that we'll get tomorrow. And initial unemployment claims continue to hover just around 200,000, 210,000, 220,000, but they're still low, is the bottom line of it all, and consistent with the unemployment rate remaining below 4%. Another thing that we might jostle the market up ahead here is loose lips from the Federal Open Mouth Committee, as I finally have been calling them for quite some time. They may get a little bit anxious here that the markets got bulled up too much at the end of last year by the summary of economic projections that they released in December, showing that they intend to cut the federal funds rate 3 times. The market decided to have a party with that, and seems to be discounting 4 or 5 times as the rate cut. So I will not be surprised if Fed officials try to calm the market down and tell them we're at most we're talking about 3, and we're in absolutely no rush to do it. Look, they had a credibility problem when they raised interest rates too little, too late, well, it wasn't too late as it turned out, but it was too late to immediately bring inflation down or to contain inflation. But I think they got wounded by that. They realized that they had acted belatedly in terms of tightening monetary policy. Maybe they should have started in late 2021, early 2022, and been more aggressive. But what's done is done, and they right now are getting a lot of praise. They're not saying mission accomplished. A lot of people are saying they're getting pretty close to being able to say that if they wanted to. And I don't think they want to say that. I think what they want to do, they wouldn't mind at all having an economy that's grown 2.5% with the unemployment rate maybe edging up to 4%, with inflation falling down to their target and keeping interest rates right around here. Why mess with a good thing? If the economy can deal with interest rates at this level, why lower interest rates aggressively? So I'm in the 2 to 3 camp on the Fed funds rate cuts next year. I'm not in the camp that thinks we're going to have 4 to 5. That almost seems to me a stealth way of some people still betting that we're going to have a recession or a significant slowdown that will require the Federal Reserve to lower interest rates a lot further. Let's look at some charts here. At the end of last year, I wrote a piece, 12 reasons to remain bullish. I decided to balance that off this morning with a piece called dozen reasons to be bearish, and then I put not in parentheses behind it. So I just couldn't help myself. I made this list of all the things that could go wrong, and then I said, well, I don't want people to say I'm kind of wishy-washy here. So I basically explained why I thought the bearish case still doesn't make sense. But at the same time, I think just because one is bullish doesn't mean that you can ignore the other side of the argument. Quite the opposite. You've got to be even more attentive to what could go wrong. So let's have a look at the charts. Let me share some here with you. This is kind of a fun chart. I'm not a big believer in history repeating itself. I think it rhymes, but it doesn't repeat itself. But here's a chart that goes back to 1928. This is let me open this up a little bit. Okay, this is with our new improved handy dandy charting program, which has become a hobby and obsession for me. Really allows me to play with the data whenever I get bored. So Figure 1 shows the years in blue that we had increases for the year, and then the bottom, the red, shows the years that the market's down. I've often, as I've said before, I've often been accused of being a perma bull. And I might have told you this. I view that as a compliment because more often than not, the market's up rather than down. And I think this just confirms that the market is more often up than down. Of course, every now and then we want to miss things like the Great Depression. We want to miss things like the Great Financial Crisis. But all in all, staying invested the way that Warren Buffett does seems to pay off over time and probably allows you to get a lot more sleep. But we did have a significant up year last year. And if this is not going to be a recession year, then the odds favor another up year this year, maybe not double digits, maybe single digits. Our 5,400 number, however, does translate into our 5,400 does translate into an increase of about 13%. So then, of course, there's this chart, which goes all the way back into the 20s, showing you the S&P 500 historically on a logarithmic chart. And again, you can see that downturns tend to occur during recessions. Other than that, the stock market tends to have a solid upward trend. And if you just put your hand over the Great Depression, it looks obviously better. But that the market's always had this kind of depression mentality, is that that could happen once again. Hey, it could. I mean, I think it was a policy mistake having to do with the Smoot-Hawley tariff, but that's a subject for a whole nother web chat. But again, the question is, are we going to have a recession in 2024? And there's still people talking along those lines, saying that they're long in variable lags. But one of the lags that's actually short, not too variable, is in the housing market. It doesn't take long for housing to take a dive when mortgage rates soar. It doesn't take long for housing starts and activity to pick up when mortgage rates decline. So it's hard to get a recession this year with the drop we've had in interest rates, and particularly mortgage rates, bound to boost housing starts, housing sales, housing-related retail sales. So that's certainly one thing that the economy is going for it. And then you got to come up with an explanation of why the consumer is suddenly going to retrench and slam the brakes. The student loan story just doesn't seem to be playing out the way the diehard Heartlanders thought. The next one is the excess savings, that consumers are about to run out of excess saving. That's been anticipated really since May of 2022. Jamie Dimon of J.P. Morgan was probably the most visible prognosticator on that subject. He said back in May of 2022 that consumers in great shape, but that's because they have excess savings. Once they spend it all, will fall into recession. And he seemed to be indicating it would happen sometime in the second half of 2023. Well, it hasn't happened yet, but it's conceivable that it could happen. But as long as the labor market indicators are as strong as they are, suggesting that there are plenty of jobs out there, I don't think we're going to have a consumer-led recession. And then, of course, wages are rising faster than prices. This is the CPI story, the PCED inflation rate. We're looking at the headline rate and the core rate. It also includes our forecast for the headline rate. And we haven't changed those forecasts, so we haven't done a rope-a-dope on you. Things have worked out pretty well for us. We increasingly have thought over the past several months that inflation has turned out to be transitory after all and not persistent, and we think it's going to continue to come down. And before you know it, we'll be at the Fed's 2% inflation targets probably by the end of the year rather than sometime next year. So that helps to take the pressure off the Fed tightening. But again, I don't know that just because they accomplish their mission of getting down to 2%, I don't know that they're kind of automatically going to lower interest rates. Some of them have said, like John Williams has said, that we might have to lower interest rates if inflation continues to drop. Otherwise, real interest rates are going to go up, and that's going to be restrictive. But I think that idea is going to be data dependent. If the economy is resilient, if it continues to demonstrate relatively good growth, 2.5, maybe even 3% growth, and inflation's coming down. Why mess with success? Why have a major drop in interest rates? One or two declines here and there when the data suggests things might be a little soft here and there might be advisable. But more than that, we're back to normal, folks. Why not? We're learning to live with what had been normal interest rates in the past. These kind of interest rates are good for the economy in the sense that they're certainly good for anybody getting interest on deposits, on treasury securities and the like. And it's a good way to allocate capital. So here's that inflation story, more detail. Just the spikiness of inflation is something we've been pointing out. Faster it goes up, the more symmetrically it goes down. Slower, so it's a lot of symmetry here. This is a much feared 1970s, the so-called Twin Peaks, and people have drawn comparisons between the two. It's not that hard to overlay this on top of this and say, look what's coming next. And this is coming next if we're going to have a major calamity in the Middle East, which is conceivable. But at this point, I don't think any of the parties really want this thing to get totally out of control. This is the services inflation rate, and what got the markets really excited on the inflation front is that super core inflation rate, the PCED, services less energy, housing, and utilities, has come down. Remember, it was kind of stuck. This is the dotted line here. It was stuck around 5%, and Powell made a few speeches about it. He basically invented the concept of the super core, and he said that, look, goods inflation's coming down and should continue to come down as supply chain disruptions are fixed. He said, look, we know that housing's kind of a weird measure of rent and that it tends to lag, and we see Zillow and apartment list inflation rates for rents are coming down. So we're not too upset about that. We're not going to look at that, give that too much weight, but we're giving a lot of weight to services core, less energy, which is pretty tiny in services, excluding housing and utilities, basically anything housing related, and that's come down quite sharply. Notice these things don't go in straight lines. Sometimes they can reverse themselves a little bit, but I think the general notion now is the correct, and that is inflation has come down. This is the Zillow and apartment list. This is just you can read it on your own. This is the stock market. I have fond memories of this period here. I think we called this bottom pretty well. I think we called that bottom pretty well. I think we called that bottom pretty well. It's just the tops I'm working on. So I'll let you know when I get that squared away. But calling the bottoms is, I think it's important that if you're going to call the top, you then have a moral and professional responsibility to call the bottom. So I don't know if the reverse applies. If you call the bottom, I don't know that you had to call the top, because stocks, if you have the philosophy that stocks are meant to be held for the long run, and when a lot of us have been talking about it, and Warren Buffett's been doing it, and Jeremy Siegel has been theorizing about it, and I'm in that camp as well. We've talked about leading indicators. They're down again, yada, yada, yada. Consumer confidence all-time record high. Could they still be right? They could still be right. But if you take the year-over-year percent change in leading economic indicators and correlate that with simply the level of the manufacturing PMI, you see a pretty close correlation. Our point has been that leading indicators is very biased towards goods. We haven't conceded. We've said that we're in a rolling recession in the goods market and retailing, but services are more than offsetting that, and that seems to continue to be playing out. This is another thing, leading indicators, year-over-year percent change versus real GDP goods, all just more confirmation from the data that it's biased towards good, and it's been correct. It's telling us there is a recession in goods. It's been incorrect if people have been interpreting that as a conclusion for overall GDP, because GDP services continues to do quite well. There's also obviously the potential for a credit crunch. The inverted yield curve has been forecasting a credit crunch. We've basically had one in the banking system, and it's not necessarily over. This is bank term lending program, and it's actually moving to higher highs. So maybe there's still something in the banking system that's going to blow up, but the Fed's demonstrated that they're pretty good at playing whack-a-mole with these liquidity crises, and they create liquidity facilities pretty quickly to calm things down. So I don't see a problem there. And oh, by the way, interest rates have come down. Financial conditions have eased a great deal. So that should take some of the pressure off the credit system. Well, how about the fact that loans on a year-over-year basis for commercial and industrials are actually negative? Well, I think a lot of that reflects the weakness in the goods economy. This is just another reflection that the goods economy has been in a recession. The C&I loans are highly correlated with business inventories, and that's what's been driving the growth rate of overall loans. So here's that story right there. Here's business inventories versus commercial and industrial loans. And as you can see, the inventories have been flat and the loans have been flat. These are levels, and they're all on the same chart. So you can see that clearly a lot of loan demand is to finance inventories. What else? Well, there's something to worry about. Lots of things to worry about. The question is, we should make a list of them, as I do, and try to monitor them as I do, and I try to put some probabilities on these things as I do. So what do we have here? We have the NFIB small businesses indicator on wages, and the small business. I saw some people kind of get really excited about this, that wage inflation is making a comeback. Small businesses are planning to raise compensation up ahead here. You'll notice that it is a pretty choppy, volatile number, and the next thing it's probably going to do is take a dive here if you just look at the choppiness of this thing. But it's conceivable that the Fed will conclude that there's still a problem with wage inflation. Powell has said that he's not that worried about wage inflation. He's really more focused on price inflation. But he has said that he'd like to see wage inflation simmer down to about 4%. He doesn't like to see it about 5%. If it figures, what was he saying? Yeah, actually, he was saying I think more like 3 to 4%, because he figures if price inflation is 2%, wage inflation can be 3 to 4% if productivity is making a comeback, which I think it is, and he's sort of implied he'd like to entertain that possibility. But here's other measures of wage inflation, and they're closer to 4% than the wage growth tracker, which is 5.2%. I thought I heard Max coming in. Okay, let's wrap it up here. I'm being long-winded. I apologize. But I've shown you this chart before. This is unit labor costs and the CPI inflation rate. Unit labor costs on a year-over-year basis down to only 1.6% in the third quarter. We had a very strong productivity numbers in the second and third quarters. I think it's not the beginning. I think it's the continuation of a productivity growth boom that started in late 2015. It was back down to 0.5%. And now productivity growth is at 1.8%. And I'm using the 20-quarter trailing annualized number for that to smooth it out. Energy, well, yeah, as I said, if we get two spikes in energy costs, we've had one spike, we get another spike, then it'll be a certain sense of deja vu all over again with the 1970s. We'll be watching that. But oil production in the U.S. is at an all-time record high, which is pretty amazing. Who would have thought that under the Biden administration with what he said during the campaign? But here we are. It's still a free country in many ways. And oil producers have been freely producing more oil. I think we're up to 13.3 million barrels per day. And that's oil field production. There's still a lot from condensate and all that. It's about, altogether, we're producing something like, I think, 22 million barrels per day in crude oil. We are a huge factor in the global oil market. So, that's creating problems for OPEC, as is China's recession and the shallow recession in Europe. And the other thing is consumers have become much more elastic in their demand for gasoline. It's partly because a lot of people don't drive to work anymore or on a consistent basis. And let me turn that off. So it's here you're looking at U.S. petroleum gasoline supplied, which is really a measure of gasoline demand. Energy Department, I guess, doesn't have any economists, and they call it gasoline supplied. I can understand their terminology, why they did it. But you can see that gasoline demand is pretty volatile, and we know with the price of gasoline went up, they cut back on their demand. Now the price is down, the demand's going up. So look, I think Saudi Arabia, Russia wanted to see the price of oil moved up to $100 a barrel and thought the global economy can handle it, and they were wrong. And I think the global economy maybe can handle 70 to 75, maybe 80, but I don't think we're going to see a spike up to 100. So I'm not expecting a second spike, Twin Peaks situation in energy causing more problems. Hey, I'm done with my charts. This, of course, is well, what about the federal deficit? What about the federal debt? How can that not be terribly bearish? And the answer is, well, it just simply hasn't been up to now. It looked pretty ugly there for a while there. I have to admit, I got a little concerned back when people started to ask me about the bond vigilantes again, and it was basically what August 1st to it was July 31st was the peak in the stock market. August 1st through November 1st that we saw this big, huge increase in the bond yield to 5%. We saw the stock market taking a correction dive of a little bit over 10%. And a lot of, when things like that happen, people look around, well, what's causing this? And, the issue, supply suddenly became an issue. The auctions weren't going very well. They're not going terribly well now, but we're all watching the auctions. But Janet Yellen, I call her the fairy godmother of the stock market bull market when she was at the Fed. Now I guess she's the fairy godmother of the bull market in the bonds that we've had since November 1st, because that's when the Treasury announced that they were cutting back on notes and bonds and doing more in the bill market. And there were some other events that happened at the time that got this monster rally in the bond market. So I am concerned about interest payments going higher and higher, but Janet's going to fund more and more with the bill market and take a risk that short-term rates are more likely to go down than go up. It'll certainly take the supply pressure off the bond market. And once again, we're learning that supply and demand really aren't that important in the bond market. What is important is the Fed funds rate, where it is, where it's going, what Fed policy is likely to do next, what inflation is doing, because that drives the Fed. So I talked too much. Let me see if I can grab a couple of questions here. Do you have a view on the U.S. dollar, generally the DXY, but also, DXY, it rallied for a while there, and then the perception that the Fed's going to ease has brought the dollar back down. I'm still fundamentally positive on the dollar. I'm not wildly bullish, certainly not bearish. The dollar tends to do well when the U.S. economy is doing better than the rest of the world. And I think that describes the current situation right now. I think China is going to remain in a funk for a while. I think Europe's going to come out of its shallow recession and have a shallow recovery while we're continuing to grow and the economy continues to do well. So from that perspective, I think the dollar stays relatively firm. If that's the case, that would argue that commodity prices don't go up, they don't go down, they kind of stay around here. They might go down if we get more of a calamity in China than we have had so far. Certainly copper is something to watch. Copper's actually been rallying of late. Oil's been rallying of late. Kind of view these as two very good daily indicators of the global economy. Kim, hi, what would you want to say to investors who have a big chunk of money in money market funds right now? Is it okay to keep making foolish, or should they start to move that money elsewhere? Well, I guess Ray Dalio was going around for a while a couple of years ago saying cash is trash, and then I think he started saying cash is king. I mean, cash is still a pretty good, safe place to get a decent return, but you're asking somebody who's fundamentally optimistic about the future. Maybe I had a happy childhood. I don't know what it is. I mean, I got 5 kids. That proves I'm an optimist. But I think that I'm talking about the roaring 2020s. And I don't think the AI thing was all hype just because I can't get any use out of it. Doesn't mean that it isn't a very powerful technology for those who know how to apply it to their tasks. But I don't think it's all about AI exclusively. I think there's other technologies in play that can be integrated. They work extremely well. They're relatively easy to implement with fewer workers. They don't cost that much, and they apply themselves to all kinds of different businesses. So that's a bullish scenario for the stock market. It's a bullish scenario for the economy. It keeps inflation down. Productivity-led growth would be good for bonds and for stocks. Was the Mao-Xi confusion intended or just a slip? With a smiley face, that was intended. I mean, there's no doubt that President Xi of China is a Maoist. He's very proud of it. He just gave a speech during, I think, the celebration of Mao's birthday, which was, guess what, very Maoist. So he is a Maoist. And people are writing stories now that he's such a Maoist that he's got these anti-corruption campaigns which are being used as a way to just get rid of anybody who doesn't agree with him. So he's got a lot of yes men and women around him. And that's a very, very dangerous situation to get a dictator in if they don't get some decent, realistic advice from the people around them. Okay, I'm going to have to pass the rest of that question. It's a little bit long. I'll look at it and I'll see if I can address it. Let's see. Ed, it seems like the U.S. is inadvertently funding both sides of both wars. That's not normal. Do you agree with this assessment? And do you believe we need a more robust policy response? Yeah, I'm going to pass on that. I can't say that I'm, all that knowledgeable about exactly what's going on with the funding of the wars. But I think we're on one side in the Ukraine-Russian war, and I think we're on one side in the Gaza war. So I'm not quite sure. But let me just pass on that. You alluded to first versus second half market performance, but didn't discuss it. What are your thoughts about the market performance pattern this year? Yeah, I'm kind of thinking that with everybody so bullish, that we got to get that bullishness down a bit, and that there are some reasons like partisan politics is going to get brought to the forefront again as the partisans in both sides of Congress just kind of create a partisan paralysis is a real possibility. That would not be good for the market. Then we discuss some other things that could be disturbing in the first half of the year. So I'm thinking maybe the first half of the year is going to be kind of the stall, whereas the second half is where we get our big gains, which would be kind of the reverse of what we had last year, where the first half was very good. We had the correction, then we made up for the correction. So it was basically a stall. All right, with that, one more. Okay, how do you feel about small caps going forward? Yeah, I mean, if the market stalls here, I'm really talking about the big cap, S&P 500, the mega cap. I think that the mid caps are going to do just fine. I think we did finally see these stocks outperforming. They're still cheap, and I think they do just fine. Happy New Year to you and yours. Thank you very much, Willem. And thank you all for tuning in. Let's do this again next week. Happy New Year, everybody, and have a great week.